So thanks for joining me today. My name's Justin Carbonneau. I am one of the partners here at Validea, and over the next 25 to 30 minutes, I'm going to be walking you through the 10 new quantitative models we've launched on Validea. Just by the way of background, Validea is a quant investment research company. We initially developed our quantitative models and model portfolios between 2003 and 2005. The initial set of strategies were based on legendary investors, so investors like Peter Lynch, Warren Buffett, Benjamin Graham, and a whole host of other strategies. Over the years, we've been keeping track of and modeling other strategies, and last month we decided to bring many of those models public to the Validea research site as part of the Validea professional research package. Many of these strategies we've been running for years behind the scenes, and we thought that subscribers would value many of these strategies as they're different from the initial set of portfolios and models on the site currently. For us, when we look to add an investment model, it needs to have certain characteristics. One, it needs to have a long-term track record behind it, either in the real world or in back tests. That's the first thing. The second thing is it needs to be published either in a book, an academic paper, or an article. And then lastly, it needs to be largely fundamental based, and it needs to be able to be computerized. And if we find strategies that meet those criteria, we'll look to capture them and include them as part of the Validea investing system. So let's start by talking through some of these new models and what goes into them. The first is the price to book growth investor model based on research by Partha Mohanram. Mohanram wrote a paper separating winners from losers among low book to market stocks using financial statement analysis. What the strategy does is it starts by sorting on the lowest 20% of stocks using the book to market ratio, which is the inverse of the price to book. So basically it's looking for high price to book stocks, so stocks of growth companies. Over the very long term, many growth stocks don't go on to beat the market because they're actually overpriced and overvalued. But what Mohan Ram identified in his paper was 8 different criteria that could separate the winners from losers within the growth stock universe. His criteria are split into 3 distinct groups. The model looks at profitability using criteria like return on assets and cash flow from operations, consistency using the variance of return on assets and sales, and a willingness for the company to invest in the future through capital expenditures and R&D and other things. One of the more interesting criteria in this model is the use of the variance or rewarding consistency of something. So both in terms of return on assets and sales, this model actually rewards companies with more consistent profitability and growth. This is a concept we'll come back up again in a few minutes, but I just think that's an interesting thing to think about the variance of something and rewarding those companies that have more consistent fundamental features. The next model is the acquires multiple investor strategy based on the book by Tobias Carlyle, The Acquires Multiple. What this model looks to do is look for inexpensive stocks that could be potential takeover targets, and it does that by calculating something called the acquires multiple. The acquires multiple is looking at enterprise value and then comparing the enterprise value to operating earnings. So it's similar to a PE ratio, but what the enterprise value tries to give you is actually the value a private buyer would pay for the company. So it takes into consideration cash and debt and things like that. What this model actually does, there's first a quality component to it. So we're trying to remove the junkiest of junky stocks. Then each stock is scored, or the acquires multiple is calculated. And then there's a final rank. So the stocks with the most attractive valuations based on the acquires multiple are the one that make it into the portfolio. The performance chart here, which I didn't mention this for the price to book to growth investor model, but we'll actually look at that on the Validea site in a few minutes. But the performance chart of the acquires multiple is, it has a margin of excess return over the market, but the past few years have been not so great for many value strategies, and I think this chart sort of reflects that, particularly since 2014, 2015, with that decline in there. The next strategy we'll look at is the earnings revision investor model based on a research report by Wayne Thorpe, who's an analyst at AAII. What studies have shown is that investors tend to underestimate the magnitude of good news when companies are performing well. As a result, the initial reaction to positive news tends to persist for a period of time. What this strategy seeks to do is take advantage of that phenomenon by selecting companies that have seen upward earnings revisions in their earnings estimates. It looks for companies with positive revisions, both the current year and the next fiscal year, and eliminates companies with negative revisions. It also looks for sufficient analyst coverage to ensure that the revisions have some statistical significance to them. So if you're an investor that values earnings estimates and companies that are seeing positive earnings estimate revisions, this is certainly a model that you would be interested in. The performance is certainly good. You'll see outperformance over the market in our testing period. There's some pretty large declines in here, particularly last year where this model really struggled. So you always want to pay attention to that. When you're looking at a model and it's long-term tested returns, you want to understand the periods that it did well and the periods that it didn't do well and why. The next model I'd like to share with you is the model we are calling the private equity investor model, which is based on the research paper Leverage Small Value Equities. What this paper tries to do is uncover small cap value stocks that have the characteristics of what successful private equity investments look like. So if you think about what private equity investors do, they look to buy companies on the cheap, and then they leverage them up and they try to turn the operations around so that the debt can be paid down and then the companies can be turned around and sold. What this model tries to do is using a set of fundamental factors, things like enterprise value to EBITDA, long-term debt in relation to enterprise value, the change in long-term debt, and a number of other things, tries to replicate private equity-like returns using public equity stocks and this strategy. And at least in the back test, what these authors showed is that they could come very close to achieving the top tier private equity-like returns by selecting stocks with these characteristics. Quantitative Momentum is a pure momentum model, and it's based on the book written by Wes Gray and Jack Vogel of Alpha Architect. The first thing that this model does is it basically defines the universe. So it wants top performing momentum stocks. And what it does to sort on momentum is it looks at intermediate term momentum. So it doesn't look at very short term momentum, and it doesn't look at longer term or 12-month longer momentum. What it basically does is it looks at momentum excluding the most recent month, and it looks for the stocks with the highest momentum based on that momentum factor. What it then does is it rewards the stocks with the least amount of volatility, because what these authors found in the study was stocks that have the least amount or the most consistent amount of performance in that momentum period ended up being the best performing stocks in the group. The portfolio is actually done pretty well. It has a margin of excess return over the market in the testing period. There are periods in there, just like all of our strategies, where you see some pretty large drawdowns. But more recently, particularly this year, this strategy is performing very nicely. The next is the value composite investor model based on James O'Shaughnessy's work and what works on Wall Street. What O'Shaughnessy developed and tested here was basically a value composite type of model. So rather than looking at just one value factor, O'Shaughnessy created a composite that uses multiple value criteria at once. So it would rank stocks based on price to book, price to sales, price to earnings, price to cash flow, enterprise value to EBITDA, and shareholder yield. And then based on all of that, look for stocks with the highest combined composite score. The other criteria that is used in this particular model is a quality screen. So what we do is we try to get the worst quality stocks out of the model's universe altogether right up front. And we do that using our quality composite score as well. The performance of this strategy, actually, given how value has done not that well for a very long period of time, this model is actually pretty respectable. I mean, it has a very large lead above the market in our testing period. And the past couple of years haven't been that bad for it. So that is interesting. I think the combination of looking at various different value criteria, not just like price to book or PE ratio, has a lot of validity, and I think that shows through in this model. The next strategy is the Twin Momentum Investor Model based on a research paper by Deshaun Hang. The research paper was just titled Twin Momentum. And what this strategy looks for is stocks with strong fundamental momentum and price momentum. So fundamental momentum is determined using a combination of 7 variables: earnings, return on equity, return on assets, accrual, operating profitability to equity, and a host of other things. It then also looks at price momentum, which again, it's using this intermediate term momentum statistic that looks at 12-month momentum excluding the most recent month. Stocks are then ranked, and the top 1 to 2 percentile stocks are the ones that are included in the portfolio. This portfolio has shown very good performance in our testing. The margin of excess return over the market has significantly jumped since 2015, 2016, which has been a period for, if you've been in the right momentum stocks, been a very good period for those types of stocks. And so I think this model has benefited from that. Shareholder yield is based on the book by Meb Faber, Shareholder Yield, A Better Approach to Dividend Investing. Shareholder yield looks for companies that are returning cash to shareholders via dividend, buybacks, and debt paydown. It's the combination of these 3 capital allocation activities that is known as shareholder yield. So rather than just, let's say, sorting on dividend yield, shareholder yield takes dividend yield, buyback yield, and debt reduction yield and combines that all into one. The model then combines shareholder yield with things like value, quality, debt, and relative strength to identify the top ranked shareholder yield stocks using a unique combination of fundamental factors. The performance is good. It pulled back at the end of 2015, but since then it's been reverting nicely and is widening its gap over the market in this testing period that we're able to test it back to. The multi-factor model is based on a research paper by Pim van Vliet, and this is a low volatility type of strategy. So what it does is it looks at the 1,000 largest stocks in the stock market, and it then reduces that list by 500 by removing the 500 most volatile stocks based on the standard deviation of returns. From there, stocks are sorted by their net payout yield, which is part of shareholder yield. It's just dividend yield and buyback yield. And then it looks at intermediate term momentum. And the end result is basically a final rank that lists low volatility stocks that are focused on returning capital to shareholders and that have been performing well relative to the market recently. As you can see from the performance chart, it's certainly a smoother chart than some of our other ones that have a lot more choppiness. And I think that's a reflection of the low volatility tilt that this model tends to have and the types of stocks that it selects. The last model is the Millennial Investor model based on the book by Patrick O'Shaughnessy. In Millennial Money, which is the book that he wrote, he basically combined a set of investment criteria, things like rewarding companies with high shareholder yield, high return on invested capital, low valuations, and then earnings quality, and also a relative strength or momentum component just to filter out stocks that are in the lowest relative strength category or have very low relative strength. The combination of these factors has led to stocks that look good based on this unique set of criteria that are being looked at. The performance of this is actually pretty good, particularly since like 2015. I think like the shareholder yield and the quality aspect of this strategy have really shined through here, and it has quite a wide gap over the market, at least in our historical testing. Okay, this next slide, I just wanted to show you the full model lineup on Validea, all the models that we offer. So everything that I just outlined and worked through, those are all part of the Validea Professional Package. The initial set of strategies on Validea, which include models based on Warren Buffett, Benjamin Graham, Peter Lynch, Ken Fisher, Joel Greenblatt, Martin Schwag, James O'Shaughnessy, John Neff, David Dremen, The Motley Fool, and Joseph Piotrowski. Those are the initial set of models. Those are all included in the Validea Standard Plan. But the models that we just worked through, those are in the higher level Validia professional package. But for those people that want to see sort of the full model lineup that are listening or watching this webinar, this is basically all the strategies on Validia. And we'll actually look at these in a little bit of detail in a minute on the Validia site. I just have this slide included. I put this in here just so you can see the different things that you can do on Validia. We won't spend too much time on this, but if you're interested in reading a little bit more, you can see about the tools and the features that are on Validia and how we've captured these strategies programmatically and how you actually can use them in your investment research process. Okay, so let's shift over to the Validia website now so that you can see actually how we've implemented these strategies in the various tools and features on Validia. So the first thing I'm going to show you is the model portfolio tool. We're not going to look at, we're only going to look at one model portfolio, but what I want to try to emphasize here is that the portfolio and the view you're getting, it's going to be the same across all the portfolios we run. It's just, obviously the performance and the stocks held in each portfolio is going to be different because each portfolio is built off of a different guru methodology, a different quantitative strategy. The portfolios on the Validia site, we run very focused, concentrated 10 and 20 stock model portfolios. The portfolios are rebalanced monthly, quarterly, or annually. So what that means is that you can choose, as a subscriber to Validia, you can choose whether you want to follow a 10 or 20 stock model portfolio and whether you want to follow a stock portfolio that is rebalanced monthly, quarterly, or annually. What we tell you on the default view of the portfolios is for each different investment model, what size portfolio and what rebalancing frequency works best. So here we're just looking at the very top performer. It's the twin momentum strategy, performs best with 10 stocks and rebalance monthly. So let's look and see actually what that looks like when we go into the portfolio here. So coming in, we see a performance chart. We can see the summary statistics here. We can see the full return history here for as far back as we can test the strategy. That's helpful because that's certainly going to tell you the years where the strategy didn't perform well. Important to note. Coming down, you can see the current set of portfolio holdings. There's two different table views. This is a performance view and a fundamental view. So as you switch to the fundamental view, you're going to see fundamentals are going to populate the table. When you switch back to performance, you're just basically seeing the performance of the holdings since these holdings have been added to the portfolio. Scrolling down the page even further, you're seeing the latest changes. So anytime we rebalance the portfolio, we last rebalanced the portfolio on April 5th, the next rebalancing is May 3rd. You're seeing exactly in each portfolio the stocks that came in and the stocks that were removed. So we tell you exactly what to buy and what to sell, then it's up to you to execute on it. And we do this for 22 different models for those that are subscribers to Validia Professional, 22 different models across a wide array of strategies. Okay, let's move to guru analysis. So I'm going to use just an example here. I'm going to use MetLife. It's a big financial company. And what you're basically seeing, and we do this for 6,000 securities on a daily basis. So you get to see how each one of these strategies scores the stock. Not only do you get like a rolled up report, which is what you're seeing here, you're seeing sort of a quick summary table, and you're getting a little bit of detail about what the strategy is and then the score for each model. But also you can click down and you can see why a particular model likes or doesn't like the stock, why it gets the score it does. So if we click into any of these strategies, we're going to see why the stock passes or fails a particular model. So here we're looking at shareholder yield. I just clicked into that one. You get to see the universe or the market cap requirement. There's the net payout yield. There's the quality and debt factors, the valuation measure, relative strength, and then shareholder yield. And so each strategy is made up of a different set of fundamental criteria, and you can see why a stock passes or doesn't pass a particular investment model. What I would also say is sometimes it's important, you can use this tool, which we call it guru analysis. You can use it not only to find like stocks that are scored really highly, but you can also use it maybe as a red flag tool. So if you have a stock idea and you type it into guru analysis and the stock gets like all zeros or a bunch of reds, so if anything really low gets a red is denoted in red here, that might be an indication that this stock, at least from a fundamental standpoint, just doesn't look solid. Maybe the company's not making money, maybe it's got tons of debt, whatever the reason. This is a pretty wide array of fundamental strategies. So if you see something that either has a lot of green or a lot of red, it's either pretty good fundamentally or not so good fundamentally. And that's how I think you can use guru analysis to your advantage here. The other part of the site I'd like to show you is something we call Guru Stock Screener. This is another way to generate ideas, new investment ideas using our system. And you can do a couple things here. You can combine different strategies. So let's just say we said, you know what, we're sort of attracted to the low volatility, quality, and we want to look for stocks that pass that model with at least with a high score. And then let's say, you know what, we're always attracted to the Buffett model because we know that's, again, another high quality, big blue chip type of model. We can combine those different models. And then what we get is a list here of stocks that pass both models with at least an 80% score. So a lot of these names you're going to be familiar with. I mean, Boeing's in here, Apple's in here, TJX is in here, Tractor Supply, Cummins, United Health. So as you can see, this list of stocks, it is reflective of what these strategies are basically trying to uncover: low vol, quality, large cap. The other thing we can do is we could say, show me stocks that pass at least, let's say, 5 gurus with strong or some interest. So that gets us stocks that pass at least 5 different strategies. Now, this is a pretty long list still, probably too long to do anything with, but then we can start adding in our own fundamental factors. And we have a lot of unique factors in our screener that you probably can't find in many other places on the web. Things like, enterprise value EBITDA, we piped in the acquirer's multiple, the value composite percentile here. You got shareholder yield, net payout yield. We got some growth and profitability factors. Momentum, 1 year relative strength, 6 month, 3 month, industry relative strength. So that's going to show the relative strength of the entire industry, and a number of other things. And then coming down here, we got some quality, return on equity, return on total capital. We got a 10-year average return on equity, 10-year average return on total capital, which are used in the Buffett model. So that's interesting. If you want to try to identify companies that have like a protective moat around their business, you could use those criteria. Insider ownership, institutional ownership, and more. So that's how someone might use the Guru Stock Screener to basically find names that pass the Guru strategies, but then you can add in your own fundamental investment criteria using these drop downs. So thank you very much for watching this, maybe even the second time. I hope you found that valuable, particularly on the new strategies that we rolled out on Validia. There are many different ones in there. And again, those are available in the Validia Professional tool. If you have questions, if you would like to talk through any of this directly with me, I am available. You can just let me know. So thank you for watching, and we do hope to see you on Validia. Thanks again. Take care.